Yeah, hi, good evening, friends. Welcome to the latest edition of Passive Speak. Today, we are going to talk about the launch of a new product, a new fund that we are launching in our index solutions suite. That is the HDFC Nifty India Digital Index Fund. You could use this to power your portfolio with the $1 trillion digital opportunity. So, as you know, a lot of things in our everyday life now is done digitally. So this product has companies which are we are exposed to on a day-to-day basis. So increasing tech intensity is a secular trend. And the next, yeah. So if you see the way how technology has changed our lives, previously we used to go to the bank to carry out our banking transactions. The same is done online today, digitally by us. We used to go to the stores to do our shopping, which used to happen offline before. Everything now happens via the apps. So, capital markets, we used to have this procedure of calling the broker or going to his office to execute a transaction and then go to the depository to give the instructions for delivery. Now, all this can happen digitally. It happens via the broker's application and which seamlessly connects our bank account, our demat account, and our trading account. The payments that we used to make for anything, whether utility payments or any other payments, used to be via check or via cash. Now all this happens digitally through the UPI apps, through net banking, through uh, whatever other means like cards which are there. Uh, Schools, still people do go offline to schools, but whenever there is an issue where students cannot attend a class, then the same can be conducted online through a Zoom webinar or through a Teams meeting. So these are the things where there are a lot of changes which are happening. Manufacturing also operations in factories now, which was done by human beings and by physical labor, are now done by what do you call robots, which help in the manufacturing. Uh, Next slide. Uh, Government also was what do you call basically having a long procedure of giving the benefits to the subsidy benefits to the citizens, where they had to go to a government office, stand in queues, and spend a lot of time there. The same can now happen through the direct benefit transfer. uh, Advertising also used to be very big physically on billboards and print ads. Now, a lot of the advertising happens on the digital platforms like the apps that a browser goes through, a user goes through. Healthcare also, previously people used to, or they rely on doctors to conduct surgeries. Now we have robotic assisted surgeries. Meetings used to previously happen only physically. Now meetings happen seamlessly through the various apps which are there through web conferences, which saves a lot of time in traveling and in reaching out to multiple people through one web conference. So the entire universe, the entire way that we connect with with the various aspects of our life, we can do so digitally, and we do not need to do it physically anymore. So, next slide. The digital economy growth is expected to outpace the GDP growth. So, India's technology sector in the last or in the next 7, 8 years up until 2030 is expected to go up 4.5 times vis-a-vis the GDP, which is expected to double by 2030. So if you can see this chart, the share of the internet economy as a percentage of the GDP was only 0.5% around 14 years back in 2010, which was only 50 to 60 billion. That has now gone to 4.5% in 2022, uh, 4 to 5% rather. And this is expected to go to 12 to 13% of the GDP by 2030. So there has been, as you can see, a steady increase in the last decade or so. And in the coming 7 years, this is expected to grow much, much faster. From 320 to 350 billion, it's expected to go from 155 to 175 billion is expected to go up to 900 to 1000 billion. So the internet economy as a percentage of the GDP is rising. It is outpacing the growth in as compared with other sectors. And next slide. The Indian digital landscape, what does it offer? So, what is it which is what you call available in this sector, which is a multi-decade opportunity? The new age companies leverage to domestic consumption. So, there are a lot of new age companies which have got listed in the last few years, which basically are a proxy for domestic consumption, but they are digitally enabled and they leverage on the internet platforms which are there. So the local drivers are they are beneficiaries of increasing digitization and formalization of the economy, rising per capita income, increased premiumization, and favorable demographics. So you can gain exposure in this new age companies to India's digital leaders across B2C and B2B channels. The other part of the landscape is the Indian IT services, which are the traditional IT services companies, which will leverage to use AI and basically participate in the global tech spending. These have been the traditional giants in the Indian IT space, where IT exports have consistently outgrown global spending. There is global exposure because of servicing or providing services to companies in Americas and Europe. India has the best uh, in tech talent availability by way of the steady stream of engineers which come through India, which help form the backbone of such services to these companies based in America and Europe. And basically, you get exposure to India's IT service champions. So, a little bit more on digitization in India. There's a long runway for growth. A large section of our people, so basically increasing internet and smartphone penetration will create the next generation of online commerce users. So a large section of people with access to internet are still untapped by online business. As you can see this chart, where there is the chart in 2020 with number of users access to internet, and then the online service users, and lastly, the online shoppers. So as you can see, the 100% penetration has not happened even in the current year. Last year's number, which is available, uh, we still have not been able to tap all the internet users which are there. We are still a long way away from that, as you can see from the smaller percentage of users of online uh, services and online shoppers as compared with the total internet bandwidth. So India's internet penetration also has a long way to go. It has grown, if you compare with someone like China, where the 63% penetration is there of internet in the population versus 44%, that has grown to 57% now in 2023 versus 75% in China. So both internet usage will increase, and within internet usage, there will be more users of online services and online app shoppers. So e-commerce boom is going to continue with a long runway ahead. Next slide, Shikhar. As you can see that the e-commerce market in India has grown significantly in the last 3 to 4 years, from $67 billion to $123 billion. This is expected to go all the way to $325 billion. E-commerce is now more than 20% of the total retail sales in US and China. In India, it's still only 8% of the total retail sales. So there is a long runway ahead for e-commerce to still continue gaining in volumes. Next slide. So the key drivers for e-commerce are food and quick commerce. They are at an inflection point. The GMV of what you call the food and quick commerce delivery is growing in rupees billion. If you see the Three from 398 billion, it has gone to 478 billion to currently 569 billion. Quick commerce still has ample room for growth. The traditional brick and mortar stores, which are there for FMCG, constitute 94% of the volume. Organized offline is only 4.6. Organized non QC is 1%, and grocery and HPC is only 0.4%. So, quick commerce still has a long way to go. Organized quick commerce is only 0.4% of the grocery and HPC. This can grow more significantly with increasing what you call internet penetration. Next slide. The insurance tech and digital lending also, as a part of India's digitized payments infrastructure expands, will grow. So the share of digital insurance premium, which used to be only 0.5% in FY19, is now gone to 5.7, is now at 2.3%, and this is expected to go to 5.7% by FY33. Digital lending has picked up in India. Um, Lending by fintechs registered as NBFCs, ICCs has gone up, as you can see in this chart, where the lending by fintechs was 4,212 crores in 1920. This has gone to 10,995 crores in 22-23. Uh, if we go to the next slide, the case study for this is new age company swings to positive operational cash flows. So if we look at the fundamental ratios for a quick commerce company, as a case in point, the adjusted revenues have gone up in the last 3 years, and the companies were first burning up a lot of cash in their operating activities. So they had negative cash flow in FY21, FY22, and FY23, but that has gone to positive cash flows in FY24. So several new age companies have placed renewed focus on profitability and aim to reduce cash burn. So when these companies are new, they spend a lot of money on advertising and on their distribution network or whatever the digital infrastructure that they need to build, and then to create awareness about it. After that initial period is over, these companies are able to generate positive cash flows, and then they focus more on profitability than just revenue growth. So we can see that happening in what you call the in this case study of one new age company. Uh, Next slide. If we look at one telecom company also, the rising average revenue per user post-sector consolidation. So previously there were 10 years back, there were 13 telecom players in India. Now that has been reduced to four. As you know, the large ones, Jio, Airtel, Vodafone. So if you see the chart for the average revenue per user over these last 10 years also, now the industry average revenue per user is increasing with time. There was a dip which had happened 5 years back. Now that again is picking up. So to sum it up, most of these new age companies, as you may have heard of the names, which we'll cover in detail during the course of this presentation, you have already heard of these marquee names like Zomato, PB Fintech, or Paytm and Nykaa. There are a lot of companies which are coming into the mainstream, and these companies are challenging the traditional companies in the normal consumer space that we have seen of financial services. And now the second part of the presentation, which covers the traditional IT services companies, my colleague Shikhar will take you through those slides.
Yes. Thank you, Sandeep. So, as Sandeep mentioned earlier on, through the India Digital Index, you are getting a mix of both the companies which have more exposure to local consumption, and you also have a large weight of the index in the older IT service champions. So almost 50% weight is in the IT service champions companies, which you are all familiar with. Again, names like TCS, Infosys, Wipro, these are all current constituents of the index. So while Sandeep has focused on the first part, I'll be talking about the second part, which is these companies which have more of a global focus. And the first slide is just to make the point that the IT industry is actually a very important pillar of the overall Indian economy. So these are just some interesting stats and numbers that in FY 2000, for example, the revenue of the entire industry, this was almost 24 years ago, was just $5.7 billion, and now that revenue has gone up to 254 billion. So many multiples of growth we've seen in this sector. Second, and which is actually very important, if you look at the chart on the right, it's showing how India's IT exports have been growing. So it was around 152 billion in FY21. Last FY, it was around 199 billion. So these are extremely large amounts. In fact, it's so large that if you look at the last 4 financial years, India's IT exports have actually exceeded our total gross imports of crude oil and petroleum. So, all the petroleum that we have to import for our own domestic consumption is almost in the last 4 financial years has been paid for in a way through our services exports by way of IT exports. So it's a very important a sector, has seen a lot of growth over the last few years and continues to remain important for the reasons I've just mentioned. And therefore, because of its strategic importance, it's always likely to get some degree of policy support as well. So while the first few companies are more, up and coming, these companies in the IT services sector tend to be more mature, more well established in their particular field. So this slide is basically talking about how the IT sector is actually giving you exposure to global trends. So we see here that almost the vast majority of the revenue, so almost 90% of the revenue of these IT services companies in aggregate, is coming from America and Europe, essentially out of India, right? So as and when there's a resurgence in tech spending, as companies abroad want to sort of get more up to date with their upgrade their internal IT platform, so on and so forth, these are the companies that they turn to, our own Indian IT service companies. So 90% of the revenue comes from abroad. Therefore, when there is reasonably strong economic growth, or in particular when there is strong growth in America, it tends to benefit these IT service, our local IT service companies. And another interesting point is that the market is quite competitive and fragmented, but by and large, whenever there is an increase in the global spending for tech, as companies want to automate and improve their internal processes, whenever they in aggregate when they spend money, we notice that on generally, IT services exports are even more than that, which means that slowly these companies are gaining share of this global tech spend through time. And um, that's a positive feature of these companies, that they are able to grow their exports even faster than the amount by which spending global tech spending is going up, right? So a very internationally focused sector. That's what the point of this slide is. This slide is talking about how the sector, it is, as technology is very dynamic. Maybe 10-15 years back, you still had CD-ROMs. Now everything is digital. Many people don't even know what a CD-ROM is. So in the same way, the IT services industry has proven to be very resilient. It's the market today is very different from the 90s and the early 2000s, when these companies were just kind of being listed, coming to the market, selling their services abroad, so on and so forth. And we can see even recently the transition has been moving from cloud and digital and overall automation of companies' internal processes to now a little bit more focus on AI, data, and cloud. So again, companies are looking to leverage companies abroad, including US banks, many types of companies, in fact, they are looking to use more and more of AI in their internal processes. So when they want to integrate these new workflows, they come to our IT service companies, for example, and that's what's providing the demand. So despite the industry changing, at one point you just have a lot of offshoring which these companies would take up. Now they are doing more value added things, such as enabling, helping companies in their automation, so on and so forth. So this is just showing that the companies are very adaptive. They are responsive to the ongoing trends in the tech market, and because of these abilities, they've been able to grow and thrive. Even as the market around them has changed, they've been able to adapt their business models and still be extremely competitive in the global market. Uh, Over here, we just want to sort of highlight that not only are these companies, as I mentioned, quite adaptable, very well established, they also tend to have stronger fundamentals than the broader index. So we've looked at two ratios here to, sort of illustrate this point. First one is the return on equity. So this is a measure of how efficient the company is, and we can see, we took a simple average of the largest 5 IT services companies in India. Their return on equity is around 28.5%. And if you look at the average Nifty company, or the Nifty 50 in aggregate, that return on equity is 15%. So this means that for every sort of rupee of capital invested, you are getting a higher return in terms of higher PAT for each unit of capital. That is exactly what the higher efficiency for these companies represents. And on the slide on the right, we can see that they actually have very little, almost no debt. So this is a very beneficial feature of companies, because sometimes when there are economic downturns, or there 2 years back, for example, there was a slowdown in the IT market, but these companies, because they have very strong balance sheets, they have a lot of cash, very little debt, as this chart shows, they are able to handle the down cycles very well. So you don't see excessive amount of pressure, in terms of their profitability or their share price, because since they don't have the debt, they are able to be more resilient during stressful times. So they are on aggregate more efficient, and also have much less debt than the broader market. And this shows that on these metrics, they have very strong fundamentals. Last slide in this section is just again mentioning that one of the big advantages that India has, and these IT service companies in particular, is that there's a very large talent pool in India, and these companies are able to tap into that quite easily. So not only are they able to hire fresh graduates, because there's a large number of them, they also spend a lot of time internally reskilling their existing employees to ensure that they are up to speed with the latest changes in the world, and to be sort of aware of how processes are changing and adapt their workflow accordingly. So this is a big advantage, because there is such good quality talent and a large amount of it. It's helpful for the IT companies, because it's easier for them to scale with the large talent pool available locally. So that was the section, on the IT service champions, household names, very well established companies, giving you exposure to global trends, and also sort of in a way partaking in the AI revolution by enabling other companies to integrate AI in their workflow, right? Now we'll just see, now that we've looked at both parts, the new age companies which are more local, domestic focused, and the export companies, right? So we put these together in the Nifty India Digital Index. So first thing, I already saw a question on this, that is this fund going to be tracking the Nifty IT index? No, that is not the case. It is the India Digital Index. And how is this different from the IT index? Well, you can see here that because of the sector weights and the stock weights, approximately 50% of the index is in the IT champions. So we've said here, in software, IT enabled services companies, etc. These are the ones I just talked about, which are more export focused, like your TCS, Infosys, so on and so forth. And 50% of the weight currently is to the new age companies. So from segments like e-commerce, fintech, online travel agencies, internet retail, all these kind of sectors. So in one scheme, right, or in one index, you are getting exposure to both these companies, which are, the new age companies, which are more consumption and domestic focused, and the well established IT services champions, which are export focused. So that's, very simple way to describe the index. You have the Nifty 500. There are about 13 eligible basic industries. So companies which are representing the India digital theme, they are eligible for selection. The largest 30 companies are chosen, which to make sure that we have 30 stocks in the index. And as I mentioned, sector weights are capped at 50%. So this is to ensure that no one sector dominates, right? So that's how the index that's the methodology underlying the index. And as we'll see in the next few slides, we'll get a better idea of exactly what kind of companies, what kind of subsectors are included in this index. So here we can see, if you look at the names on the right, it's a mix of the IT services companies and the new age domestic consumption companies, right? So just if you read through even the top five, you'll see this mix. HCL is IT service, PB fintech is new age, info edge is also new age, TCS Infi, they are back into IT services, Bharti Airtel is telecom, Zomato is new age. So like I said, you have a very diverse mix of companies split fairly evenly between the IT services and new age, right? And the top 10 constituents are around two-thirds of the index in terms of the weightage. I think this slide also is quite important for investors, just because you can see here we've listed all of the 30 constituents. So previous slide was just the largest 10. Here you have each and every of the 30 constituents listed, and also what basic industry are they a part of, right? So for example, software and consulting in computers, those are your IT services companies, all familiar names, split across large cap, mid cap. In e-retail, e-commerce, we have Zomato and FSN. FSN is actually is Nika, but their official name is FSN. But we all will know it better as Nika. Fintech and e-retail, e-commerce has around 10.5% weight. Then you look at fintech, you have PB fintech, which is Policy Bazaar, and 197 Communications, which is Paytm. And likewise, you can see, internet catalog retail, InfoEdge. So this is the company behind Naukri.com, imjobs.com. That's their sort of bread and butter. InfoEdge also tends to have, they own they own a portion of PB FinTech and Zomato. So that's another segment, which is covered in this index. And the last large segment is telecom. So here you have Bharti, Tata Communications, and Vodafone. So here at this point, there are 8 basic industries. A basic industry, you just can think of it as a subsector or a a mini segment of the overall digital theme. So you have 8 basic industries, and you can see here from the names, from the industries and the weightages, it's very well, spread across the new age companies and the existing IT services champions. Very quickly, this is just a little bit more detail on the breakup. So again, we've given the basic industry weights. What is important to note is that you also are getting quite a bit of exposure. It's spread across large, mid, and small. Large and mid are definitely dominating, but it's not that this index is very skewed towards one market cap segment. It's actually spread across all three, with the bulk of the weight being split across large cap and mid cap. So that's an interesting feature, because by and large, mid small tend to have a little bit more growth potential. Large caps generally offer more relative stability. So having a mix of all three in an index is again a very interesting proposition for investors. Just last couple of slides before I hand it back to Sandeep to conclude. just very quickly, we can go through the performance of the index. It has outperformed. So the Nifty India Digital TRI, mix of all these new age and IT services companies, has outperformed the parent Nifty 500 index over the last 1 year and 5 year. In the last 3 years, it has lagged. The reason is that actually after COVID, the index had done very well because many of these companies, they were massive beneficiaries of the work from home revolution at the time. More and more people were ordering from Zomato, for example. IT services companies actually got huge. They saw very high growth in that period because every company was in a rush to automate. So that mini cycle peaked around 3 years back, right? So you can see. I don't know if you can see the cursor on the slide, but that's the point where it peaked, and then the index went into. It had a bit of a fall and a consolidation. So that's why the 3 year return is not as good as the 1 and 5. But overall, we see that the recent performance has been quite strong, and even extremely recently. So just in the last week or few months, this index has generally fallen less than the broader Nifty index or the mid cap 150 index, for example, right? So that is the recent performance in a nutshell. And here we have the performance by financial year. So here we can note that out of the 19 financial years for which we have data, around 60%, so 11 times, 57, 58% of the time, the digital index has done better than, or has outperformed, fallen less by the Nifty 500, right?
Hmm.
And here also we can see, as I was saying, after COVID, there was this spike, very high growth rates for the companies that was reflected in the share prices. FY 21-22, that index did better than the Nifty 500. In 23, as I said, there was some amount of consolidation and pullback. And then again, in 24 and 25 so far, the index has been doing better than the 500, driven partly by the IT services companies coming sort of recovering, and also some impressive performance from some of the new age companies. So all these, because the index is a combination of all these, you've seen the outperformance in the last few years versus the Nifty 500. So with that, I'd like to conclude my section and now hand it back to Sandeep to summarize, conclude.
This is an index fund, so it is run at a much lower cost, and that is suitable for investors who want to invest for the long term. Uh, this being a sector fund, we want to cover what are the key risks in this fund, because the fortunes of the fund are tied to the particular sectors to which it has exposure. As we had mentioned, there were these eight sectors which were there. So the key risks are that the competitive intensity and or technological disruption which will be faced in the sector. So that is one of the key risks. The mitigant to that risk is that there is a relatively strong moat for the companies which have established the client relationships over very long periods of time, and they have spent significant amount of money in skilling talent and develop this competitiveness. And thirdly, they also have the adaptability to keep pace with the technological evolutions which keep happening over time. The second risk is that the employee turnover or the war for talent is very intense in this companies. The mitigant for that is the scale of talent supply in India balances out the issue of employee turnover over the medium term. So there is a steady stream of supply of skilled IT talent which is available in India to take care of these risks, where whenever there is a risk of very high attrition, where there are spells where these things happen. Uh, Third risk is that the dependence on global economic growth or the macro variables for IT services companies. So IT services companies are exposed to the global market because a lot of their clients are based in America and Europe. Any global slowdown impacts the business of such companies. Uh, the mitigant to that is that the value proposition of efficiency and revenue. generation, making tech spending more sticky across economic cycles. The sharp currency moves impact near-term profitability in the long term. So this is usually passed on to the customers. The other key risk is government regulations keep changing, like how you have in US that we had this visa issue for the software employees who were going to work on site at various client offices. The mitigant is that restrictions to global mobility, the immigrant visas and or increase in immigrant wages could impact near-term fundamentals. In the medium term, such restrictions or increase in cost lead to higher offshoring, so that more work will be done offshore rather than on site at the customer's office. Historically, this index has exhibited higher volatility and drawdowns than the Nifty 500 and the Nifty 50. But investors who want to invest in equity markets can, look at their risk return profile, and they can use an SIP route to invest in a sector or a thematic fund like this. And if one is able to have a long holding period, you can ride out these fluctuations, and this can lead to maybe good returns over the long term. This is a sectoral thematic fund, so it carries higher risk than a diversified equity mutual fund, and on account of concentration to specific sector, and so the sector risks are more magnified in this fund. So it would be better for an investor to take a controlled exposure to such funds in their overall equity portfolio to make the most of the investment in such a product. The key strengths HDFC AMC has in passives is that it has been managing index and ETF products for more than 20 years. We have a wide product range. We have 19 ETFs, 22 index funds, and 3 fund of funds. We have 7 market cap based ETFs and 9 market cap based index funds. We have 4 sector based ETFs and 1 sector based index fund. We have 5 smart beta ETFs and 4 smart beta index funds. On the commodity side, we have 2 ETFs and 2 fund of funds. On the fixed income sides, we have 8 index funds and we have 1 ETF, 1 international fund of fund. So we have, market leadership in market cap based index funds. In commodity ETFs, we have a very long history of 12 years plus in managing them. In the small cap ETF category, we are the industry leaders and we are gaining in size. So just to summarize about the fund, this is a open-ended scheme which will be tracking the Nifty India Digital Index, the total return index. The objective of the scheme is to, generate returns that are commensurate with the performance of this particular index, subject to the tracking errors. The fund managers for this product or this fund are Nirman Morakia and Arun Agarwal. The benchmark for this fund is the Nifty India Digital Index. The exit load is nil, and minimum investment amount during NFO and on an ongoing basis would be rupees 100 and any amount thereafter. So that concludes our presentation. In the risk meter, this is a very high risk, what you call rating, which it has got.
Okay, thank you, Sandeep. So I think with that, we can conclude the call, Raj.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.